Hello everyone. Today with Group B, we're going to present it about acquisition and disposition of property, plants, and equipment. Before our team Group B going to present it, I will introduce our team. At first, my name is Nabilah Nur I. Last digit NPM is 096. The next is Talitha Novia R with last three digit NPM is 358. After Talitha, we have Janice Marella P with last three-digit NPM is 251. The next is Prita Luneta K with last three-digit NPM 171. And the last is Ignatius Ardino Miskha with last three-digit NPM 121. After it, I will explain about valuation and acquisition costs. First is cost of land. It means costs that include all expenditure to acquire land for use. It's used for purchase price. Example is purchase price and closing costs. Next, cost of grading, filling, draining, and clearing. Assumption of mortgages and land improvement. The second is cost of building. It costs that include direct costs related to acquisition. Example is material, labor, and overhead, professional fees, and building permits. The last is cost of equipment, the cost that includes all costs incurred in acquiring and preparing the equipment for uses. For example, is purchase price and freight or handling, insurance while in transit, special foundation like assembly, installation, and trial runs. And the next is self-constructed assets. It's assets when company pull in on asset, it must allocate materials and direct labor. So company handle overhead in one of the ways. The first is full costing approach. It means that approach that assigns a pro rata portion of fixed overhead to the asset to better match costs with future revenues. The second overhead ways is constraint. It means if construction costs exceed what an independent producer would charge, the asset is recorded as a loss to avoid overvaluing the asset. The next material will be presented by my friend. In the first learning objective, I will explain the first is the meaning of property, plants, and equipment. Property, plants, and equipment, or we call it PPE, it's a tangible or durable asset that held for use in operation, such as production, rentals, or administration rather than for sale. It has multiple aspect. The first one is acquired for use in operation. So PPE is not intended for sale or held for price appreciation like investment. The second is long-term and depreciated. PPE is provide services over multiple years and not only a short term. The last is physical substance. It's a tangible asset or is distinguish them from intangible.
Hello everyone, my name is Talitha Novia R with the last three digit of NPM 358. Today I will tell you and explain about the learning objective of two. With the first slide is borrowing costs. First, what are borrowing costs? Borrowing costs are simply the interest you pay on loans. When does this become an accounting problem? Borrowing costs occur during the construction of long-term assets, like when you are building a new factory, a large machine, or a ship. And why this is important? Because during construction, the asset is not yet generating revenue. So the main issue is this. Should we expense the borrowing cost right away, or should we capitalize it? That meaning add it to the cost of the asset. If we expense it, the internet reduce net income immediately. If we capitalize it, the interest becomes part of the asset's cost and we depreciate it over time. There are three approaches. I will explain you three approaches that have been debated over the years. The first approach is expense all borrowing costs. This means every dollar of interest during construction goes directly to interest expense on the income statement. Nothing is added to the asset cost. The problem with this approach is it ignores the fact that asset is not producing revenue yet. Many people think this is too conservative. And the second approach is capitalize all costs theoretical. This approach says capitalize all borrowing costs, including interest from debt and a theoretical interest from equity. Why? The problem is calculating interest on equity is subjective and difficult. And the third one is capitalize actual borrowing costs. And this is the IFRS correct approach. This is the middle ground. We only capitalize real interest from real debt. We do not try to calculate interest on equity. This approach is objective, practical, and follow historical costs. So the correct answer or the most approaches good approaches is the third one. Okay, so in the slide 2, I will tell the most important slide. That is how to calculate capitalize of interest. There are two kind of methods. Which method you use is depend on where the money comes from. The first one is specific debt. Specific debt means the company borrows money just for this one asset, a special loan. The formula is capitalized interest equal borrowing cost minus with investment income. So, borrowing cost is the total interest you pay to the bank. Investment income is the money you earn from investing the unused loan money. So, you take the interest you pay minus with the interest you earn from idle cash. The result goes to asset cost. The second method is general debt. General debt means the company does not have a special loan. The company uses its regular loan that already exists. The formula is capitalized of interest equal average carrying amount multiply with capitalization rate. Also, there is in the bottom there is key definition. The first one is average carrying amount. Average carrying amount, this means weighted expenditures. So what is weighted expenditures? It means you take all the money you spend on construction during the year. Then you give more weight to money you spent earlier. And the second key definition is capitalization rate. Capitalization capitalization rate, this means weighted average interest rate. What is weighted average interest rate? It means you take all the company's loan. Each loan has a different interest rate. You calculate the average, but the bigger loans get more weight. Okay, so in this third slide, I will explain about example calculation using the specific debt method. So first, I will give some scenario. The company has a loan of $1 million, special loan for this asset. The interest rate is 10% per year. During construction, the company has some extra cash from loan. They invest this extra cash. They earn $20,000 from that investment. So the loan is $1 million. The interest rate is 10% and the investment income is $20,000. Let's calculate. Step 1, calculate borrowing cost. By $1 million multiply with 10%, so we will get 100,000. So the company must pay $100,000 in interest for the year. Step 2 is calculate capitalize of interest. We use the specific debt formula. Capitalized interest equal borrowing cost minus with investment income. So 100,000 minus with 20,000 So we get $80,000. The conclusion is what happened to this $80,000? This $80,000 is added to the asset cost. It goes into the building account or equipment account. Over time, the $80,000 will be depreciated together with the rest of the asset cost. And what about the remaining of interest? The 20,000 investment income effectively reduced the interest that we can capitalize. Hei kamu loh, create terus.
The next material is about valuation of property, plant, and equipment. So, the company should record property, plant, and equipment at the fair value of what they give up or at the fair value of the asset received, whichever is more clearly evident. So the first point is cash discount. When a company buys plain asset with a cash discount option, if the discount is taken, it is recorded as a reduction in the asset's purchase price. And then the debate is about when the discount is not taken. The first approach is more commonly used. The approach is like the discount is still treated as a reduction in the asset cost because the true cost is the cash price. Not taking the discount isn't as inefficiency or a management mistake. And the second approach is the asset cost is not reduced if the discount isn't taken, since keeping this discount may be reasonable depending on circumstance. And the conclusion is both methods exist, but most companies use the first approach. And then the second one is deferred payment contracts. To properly reflect cost, companies account for asset purchased on long-term credit contracts at the present value of the consideration exchanged between the contracting parties at the date and the transaction. The example is like the Greenhouse Company purchased an asset today in exchange for a $10,000 zero interest bearing note payable 4 years from now. The company would not record the asset at $10,000. Instead, the present value of the $10,000 note established the exchange price of the transaction, the purchase price of the asset, and then assuming an appropriate interest rate of 9% at which to discount the single payment of $10,000. Due 4 years from now, Great House record this asset at 7,000.48.30. It came from $10,000 times 7,000.84.30 dollars. Okay, the next matter is deferred payment contracts. So when no interest rate is set or if the specified rate is unreasonable, the company inputs an appropriate interest rate. The company used the cash exchange price of the asset acquired. It determinable as the basis for recording the asset and measuring the interest element. The example is Sutter AG purchased a specially built robot spray painter for its production line. The company issues a 10 100,000 for 5 year zero interest bearing note to Rackley Robotics for the new equipment. The prevailing market rate of interest for obligation of this nature is 10%. Sather is to pay off the note in 20,000 installments made at the end of each year. Seller cannot readily determine the fair value of this especially built robot. Therefore, Seller approximates the robot value by establishing the fair value or present value of the note. Okay, this is the record of the journal, and then on the date of purchase is equipment 75.816, and then notes payable on credit, and then end of the first year, and then we calculate the present value of note with PV PVOA, and then we journal entries like end of the first year with the interest expense not payable on the debit and the cash on credit. So the interest expense and notes payable must balance with the cash that already said 20 20,000. So after first year, we record for the second year. So the six the the 6.340 is came from 75,816 minus with 12,418 and times that. So the interest expense and not payable is on the credit side, and the cash sorry, interest expense and not payable is debit side, and cash is on credit side. Okay, the next is lump sum purchase. So a common challenge in valuing fixed assets arises when a company purchase a group of assets a single lump sum price. The example is to illustrate Nordic Homes Inc. decides to purchase several assets of a small heating concern, Comfort Heating, for $80,000. Comfort Heating is in the process of liquidation. Its assets sold are as follows. Okay, the first one is we record what asset does we have, like inventory, land, building, and then the book value and fair value. And the second step is Nordic Homes allocates the $80,000 purchase price on the basis of the relative fair values. So we calculate each asset like inventory like $25,000 divided by 10,000 sorry $100,000 times with $80,000, same like line and building. Okay, the next one is issuance of shares. If trading of the shares is active, the market price of the share issued is a fair indication of the cost of the property acquired. The shares are a good measure of the current cash equivalent price. So the example is Upgrade Living Co. decides to purchase some adjacent land for expansion of its carpeting and cabinet operation. In lieu of paying cash for the land, the company issues to the land company 5,000 ordinary shares par value 10 $10, and then that have a market price of $12 per share. And then this is the journal record. Land land is on the debit side, and then the calculate is $5,000 times with $12, and then the 60,000 is on the left on the debit side, and the share capital ordinary and share premium ordinary is on the right side. The next point is exchange of non-monetary assets. So the companies account for the exchange of non-monetary asset on the basis of the fair value of the asset given up or the fair value of the asset received, whichever is clearly more evident. Thus, companies should recognize immediately any gains or losses on the exchange. The rationale for immediate recognition is that most transactions have commercial substance, and therefore gains and losses should be recognized. So this is the like the key of the um, commercial substance or no commercial substance. So the first one is applies to exchange of non-cash assets or PPE, and then the main rule is fair value plus recognized gain or loss. The commercial substance is equivalent with change in cash flow. So if it has commercial substance, we could use fair value and recognize gain or loss immediately. And if there is no commercial substance, we we should use book value adjusted and do not recognize gain or delay it and recognize loss. The formula is gain or loss equivalent is fair value minus book value. Okay, the next is government grants. Government grants are assistance given by the government to companies in the form of resources, such as cash, asset, or benefits. In return for meeting certain conditions related to their operation, these grants can include subsidies for investment, research, or environmental programs, as well as benefits like debt forgiveness or low-interest loan. The main accounting issue is how companies should properly record and report these grants in their financial statement. Okay, so this is the accounting approach. When a company receives a government grant to acquire an asset like property, plant, and equipment, it should record the asset at fair value, not zero, because recording nothing would ignore the increase in wealth. The main issue is how to record the credit or grant. There are two approaches. The first approach is the equity approach and the income approach. The equity approach records the grant directly in equity, while the income approach treats it as income. Under EFRS, companies must use the income approach, meaning the grant is recognized as income over time and matched with the related expense. Okay, to illustrate application of the income approach, consider the following three examples. The first example is grant for lab equipment. Spectrum AG received a 500,000 subsidy from the government and to purchase lab equipment on January 2nd, 2022. The lab equipment cost 2 million, has a useful life of 5 years, and is depreciated on the strike line basis as indicate spectrum can record this grant in one of two ways. Okay, the first one is credit deferred grant, revenue for the subsidy and amortize the deferred grant revenue over the 5-year period. And the second, credit the lab equipment for the subsidy and depreciate this amount over the 5-year period. Okay, the first step is if Spectrum choose to record deferred revenue of 500,000, it amortizes this amount over the 5-year period to income 100,000 per year. The effect on the financial statement at December 31st, 2022 are shown in this table. So this is the statement of financial position, like as the current asset equipment less with accumulated depreciation, and then non-current liabilities, deferred grant revenue, and the income statement goes like grant revenue for the year is 10 for the year for each year is 100,000, and then the depreciation expense for the year is 400,000. So we are lost. The effect is lost. And then the if Spectrum choose to reduce the cost of the lab equipment, Spectrum reports the equipment at 1.1 1 million point 500,000, and why is 1.5 million is because 2 million minus with 500,000 and depreciate this amount over the 5-year period. So the statement of financial position goes like this, and then the equipment is 1.5 million, and then less with accumulated depreciation with 300,000. The result is 1.2 million, and then income statement is depreciation expense for the year is 300,000. For example 2, grant for the past losses. Flyway Airlines has incurred substantial operating losses over the last 5 years. The company now has little liquidity remaining and is considering bankruptcy. The city of Plainfield not want to lose airline service and feels it has some responsibility related to the airline losses. It therefore agrees to provide a cash grant of 1 million to the airline to pay off its creditors so that it may continue service because the grant is given to pay amount owed to creditors past losses. Flyway Airlines should record the income in the period is received. So this is the journal entries. The cash is on debit side and the grant revenue is on the credit side, and the amount is 1 million. Example 3, or the last example, is grant for borrowing costs. The city of Puerto Aloha is encouraging the high tech firm TechSmart to move its plant to Puerto Aloha. The city has agreed to provide an interest-free loan of 10, $10 million, with the loan payable at the end of 10 years, provided the attachment will employ at least 50% of its workforce from the community of Puerto Aloha over the next 10 years. Touchmark's incremental borrowing rate is 9%. Therefore, the present value of the future loan payable is $10 million. Is the calculation is $10 million times with 660 0.64 6464993, and the interest is 9% and the year is 5. And then the journal record is cash and notes payable, cash in on the debit side and notes payable on the credit side. The amount, like, after recalculating debt. In addition, using the deferred revenue approach, the company records the current as follow: the cash is on the debit and deferred current revenue is the cash is on the debit and deferred current revenue is on the credit. So the nominal the amount is three million point 500,700 500,000 point 700 at the same and the credit. Okay, the next matter will be presenting with my friend.
Hello, my name is Prita Luneta K with last 3-digit NPM 171. In here, I will explain about the cost subsequent to acquisition. So, cost subsequent to acquisition is cost that met to obtain future economic benefit. The future economic benefit in here, it means it increase useful life, quality of product, and quantity of product. It can choose one of the three or maybe more than one. And also, cost subsequent to acquisition can be treated as cost to be capitalized or cost to be expense, depends on whether the thing will make future economic benefit on company or not. If it make future economic benefit on a company, the cost will be treated as capitalized. And if not bring future economic benefit on a company, it will be treated as cost to be expensed. If the cost is treated as capitalized, there are three approaches to use when using capitalized. The first approach is substitution method. How we use substitution method is we remove the old asset cost and its accumulated depreciation and record the new asset cost else and also recognize a gain or loss. And then the second method is capitalize the new cost. How we use the capitalize the new cost is we directly debit the asset account. And then the last method is charge to accumulated depreciation. It means uh, it means used when the expenditure primarily extend the useful life of the asset without necessarily improving the quality of quantity of output. How we use the third method is debit accumulated depreciation. And then next, we will talk about the type of cost subsequent to acquisition. So the type of cost subsequent to acquisition is have four types. The first one is additions. It means the cost is increase or extension of existing asset. We treat addition with the capitalized because it increase economic benefit on the economy. We use capitalize in which capitalize the new cost method. And then the second type is improvement and replacement. Improvement and replacement is two different things. An improvement is the substitution of a better asset for the one currently used. Meanwhile, replacement is the substitution of a similar asset. So the biggest difference between improvement and replacement is the new asset. So in improvement, the new asset is have a better quality than the old one. Meanwhile, in the replacement, the new asset is have a similar or maybe equal quality with the old one. Uh, if in the improvement and replacement, treat as capitalized, which substitution method. Like example, Instinct Enterprise decide to replace the pipes in its plumbing system. A plumber suggests that The company used plastic tubing in the place of the cast iron pipes and copper tubing, with the information that the old pipe and the tubing have book value 15,000. The cost is 150,000, and accumulated depreciation is 135,000. And then the residual value is 1,000. I mean, and then the plastic tub, or the newest suggested asset, is cost 125,000, and if instinct pays 100 to 40 24,000 for the new tumbling after exchanging the old tumbling. How we record it is, as I explained before, that substitution method is we will uh, we will erase the old asset and also the depreciation of the old asset, and then we record the new asset and then the gain or loss of the asset. So the first thing in here is we debit the new asset, which is cost 125,000, and then we debit or we erase the accumulated depreciation of the old asset, which is 135,000. And then because the book value of the old asset is 15,000, minus with the residual value is 1,000, the sisa value is only 14,000. That's why we debit the loss on disposal only for 14,000, and then we credit the equipment, the old equipment, which is cost 150,000, and then cash 124,000. And then next, the third type of cost subsequent to acquisition is rearrangement, which is movement of asset from one location to another. We treat rearrangement is use capitalized or expense, depend. If it bring benefit in the long term, uh, we treat it as capitalized. But if it not, then we treat it as expense. And then the last type of cost subsequent to acquisition is repairs. It means expenditure that maintain asset in the condition for operation. Repairs has two types. The first one is ordinary repair, and then the second type is major repairs. So ordinary repair has purpose to maintain a current condition. Example is changing the oil in the delivery truck, uh, and we treat ordinary repair as expense. Meanwhile, the major repairs has purpose to improve or extend life of asset. Example like change old asset with better one. We treat the major repair using capitalized. So the difference between ordinary and major repair is, ordinary not bring economic benefit on the company, meanwhile the major repair bring economic benefit on the company. That's why they treat differently, because the ordinary not bring any economic benefit on the company, uh, so it treat as expense, meanwhile the major bring economic benefit. That's why it treat as it treat with the capitalize.
Alright, now it's my turn to explain about the disposal of property and plant equipment. Firstly is the general accounting requirement where, regardless of the method of disposal itself, a company must record every depreciation up to the date of disposal. This also ensures that the asset book value or carrying amount is accurate at the time of transaction. And firstly is there's the sale of planned asset. I'm sorry. When a company sell a planned asset, it follow a few steps. Firstly is to the update of depreciation, where recording depreciation for the period between the date of the last depreciation entry and the actual date of the sale. Secondly is removing asset account, where the cost of asset is and its related accumulated depreciation must be removed from accounting record. And lastly is the meaning of gain or loss, where with gain is when recognizing if cash is proceed from the sale are greater than the asset book value. And for loss it's like the gain but if the cash proceed are less. Okay, and lastly is regarding involuntary conversion. It occurs when an asset service is terminated by force outside the company control, such as fire, flood, or combination or any other natural disaster. And for the accounting treatment itself, is that the company report the difference between the amount recovered and the asset book value as a gain or loss. And nextly is the recognition of gain or loss. With this is basically in the same manner as the other type of asset disposal. Lastly is the example case of this inventory conversion, where if a tornado destroy a building costing 6 million with 20, with $2.5 million accumulated decimation, the company record a loss from tornado of $3.5 million. And if the insurance later pay, it recorded as a gain from insurance settlement. Alright, that's all from us. We are sorry if there is anything wrong, and we hope that the material that we have presented about could help you in your approach to studying accounting. That's all from us. Thank you for your attention.